Hey, quick question before we dive in. Have you ever looked at your mortgage statement and thought, wait, what's this PMI thing? And why am I paying for it? Or maybe you've heard people say, just put 20% down and you won't have to deal with it. But let's be real, not everyone has that kind of cash. PMI isn't some evil scam designed to drain your wallet forever. It actually serves a purpose. But here's the kicker. Most people don't realize they can get rid of it way sooner than they think, and that's exactly what we're covering today. In this video, I'm going to break down exactly how PMI works, why lenders require it, how much it's really costing you every month, and the exact steps to cancel it, including the legal rules that force your lender to remove it. Alright, let's set the scene. Imagine this. You just bought your first home. You're excited, moving in boxes. You sit down to review your mortgage statement, and there it is, this line item called PMI. Here's the thing nobody tells you up front. PMI doesn't protect you. It protects the lender. PMI stands for Private Mortgage Insurance, an extra fee tacked onto your payment if you put down less than 20%. I know what you're thinking. Insurance? Does that mean my house is insured? Nope. That's homeowners insurance. Totally different. PMI covers the bank if you stop paying and they have to foreclose. Quick example. Say you buy a house for $300,000 and put down 10%, which is $30,000. That means you borrowed $270,000. Because your down payment was under 20%, the lender says, "We need PMI on this loan." PMI isn't flat. It's usually 0.2% to 2% of your loan per year, depending on credit score and down payment. Say your rate is 0.8%. That's about $2,160 a year, or roughly $180 a month added to your payment. And you're not paying that for a couple months. Some people pay PMI for 10, 11, even 12 years before it disappears, if they don't take action to remove it sooner. Before we go further, this channel is all about taking complicated financial stuff and breaking it down simply. No jargon, just straight talk. If you're learning something right now, hit that like button and subscribe so you don't miss what's coming. So, why does PMI exist? Lenders manage risk. When you put down less than 20%, that's a higher risk loan. If prices drop and you owe more than the house is worth, you might walk away. Say the market crashes and your $300,000 house is now worth $250,000. If you stop paying and the lender forecloses, they sell it for $250,000, but you owed $285,000. PMI covers part of that gap. Important: PMI only applies to conventional loans. FHA loans have MIP instead, which can last the whole loan. VA and USDA loans skip PMI entirely but have their own fees. So PMI protects the lender and adds to your payment. But how long do you have to keep paying it? And more importantly, how do you get rid of it? That's next. There's a federal law called the Homeowners Protection Act, passed in 1998 and effective July 29, 1999. It gives you specific rights to get rid of PMI, and most lenders don't advertise it. There are 3 ways PMI can go away: automatic termination, borrower-requested cancellation, and final termination. Let's break each one down, one at a time. First, automatic termination at 78% of original value. Notice I said original. That's what the home was worth when you bought it, not today. The lender must cancel PMI once you hit that number. Back to our $300,000 example, 78% of that is $234,000. Once your balance is scheduled to hit $234,000, the lender must cancel PMI, even if your home dropped in value. The law says they just have to do it. One catch: you have to be current on payments. If you're behind when you hit 78%, the lender waits until you catch up. But once you're current, they have to cancel it. Second way, borrower-requested cancellation at 80% of original value. In our example, 80% is $240,000. Once you hit that, you can write your lender and ask them to cancel PMI yourself. But there are requirements. Your payments must be current, good payment history, no extra liens on the property, and the home's value hasn't declined below what you paid. Pro tip: if you've made extra principal payments, you can reach that 80% mark sooner than your original schedule says. Borrower requested cancellation is based on your actual balance, not the schedule. Third way, final termination. If PMI hasn't been canceled by the midpoint of your loan, 15 years on a 30-year mortgage, and you're current, the lender must cancel it as a backup rule. So how do you actually make this happen? Step 1. Pull up your mortgage statement and figure out your 80% and 78% thresholds based on your home's original value. Step 2. Consider extra principal payments. If you're 6 months from 80% and paying $150 a month in PMI, that's $900 more. Extra payments could cut that timeline and save you real money. Step 3. Check if your home appreciated. If it's worth more now, you might qualify for cancellation based on current value, even if your loan balance hasn't hit 80% of the original price. Example: house worth $350,000 now, balance $260,000. That's 74% of current value, over 20% equity, even though it's only 86% of the original price. A new appraisal could unlock cancellation. Step 4. Contact your lender in writing. Say you believe your balance has hit the threshold and request cancellation. Get everything documented. Don't just rely on a phone call. Step 5. Follow-up. Once canceled, the lender must stop billing within 30 days and refund any overpaid PMI within 45 days. If they stall, escalate, or file a CFPB complaint. Other options: refinancing. If your home appreciated and you have 20% equity, a new loan might skip PMI entirely. But closing costs can run several $1,000s. Do the math first. Watch out for lender-paid PMI, or LPMI. The lender pays upfront, but charges you a higher interest rate instead. You're still paying, just hidden, and much harder to cancel. One more trick to avoid PMI upfront: a piggyback loan. Put down 10%, take an 80% first mortgage, and a 10% second mortgage. No PMI needed, since the first loan is at 80% LTV. Let's put it all together. $300,000 house, 10% down, $270,000 loan, PMI rate 0.8%, $180 per month, 30-year mortgage at 6.5% interest. Without action, you'd pay PMI for about 12 years. That's $25,920 in total PMI over 12 years if you do nothing. But request cancellation at 80% plus extra payments, and you could cut it to 8 years, saving $8,640. PMI isn't something you have to accept forever. You have rights under federal law, and you can take action to cancel it and save thousands over the life of your loan. If this helped, hit like, drop a comment on what financial topic to cover next, share it with someone paying PMI, and subscribe with notifications on. Thanks for watching. See you next time.